Welcome to the FSB Virtual Outreach event on sound practices for financial institutions' responsible adoption of artificial intelligence or AI. I am Yasushi Shina, member of the Secretariat, and my colleague Shatsukita is sitting next to me. We will be supporting this virtual event. Today's event comprises of 3 sessions. First, Vice Chair Berman of the U.S. Federal Reserve Board and the chair of the FSB Standing Committee on Supervisory and Regulatory Cooperation will provide opening remarks. Her opening remarks will be followed by a presentation on the FSB Sound Practices Report by Deputy Managing Director Ho Han Shin of the Monetary Authority of Singapore, who leads the FSB workstream on AI. We will then have a discussion session to exchange views on the FSB report, starting off with 3 lead speakers from the private sector, followed by views from the audience. Before I hand over the floor to Vice Chair Berman, I would like to make 3 housekeeping remarks. First, as notified in the registration, this event is recorded and may be published in the future. Second, any views or questions participants would like to raise to the speakers should be sent via chat message function to the FSB Secretariat that is shown as hosts. Third, when we open the floor for discussion, participants may raise their virtual hands to intervene. Thank you for your understanding. I would now like to hand over the floor to Vice Chair Berman. Vice Chair Berman, the floor is yours.
Thank you so much. And I really want to thank you for the opportunity to join this group today to discuss the Financial Stability Board's consultation report on sound practices for the responsible adoption of artificial intelligence. Both our Federal Reserve staff and staff from the FSB Secretariat are eager to consider and incorporate feedback on the consultation report so that we can finalize the report later this year as a US G20 deliverable. Before offering a few thoughts about the report itself, I'd like to thank Hearn Shin Ho from the Monetary Authority of Singapore. Hearn Shin led this FSB workstream that produced the report in a very compressed timeframe. And I'd also like to recognize and thank the FSB Secretariat who supported this work. And finally, I'd like to thank our U.S. colleagues at the Treasury Department and the Securities and Exchange Commission, who also collaborated with us to produce this report. As many of you know, I chair the FSB Standing Committee on Supervisory and Regulatory Cooperation. In setting out my priorities late last year, I initiated work on a set of sound practices for financial institutions to consider in the responsible adoption and use of artificial intelligence. Since that time, AI has continued to rapidly evolve and financial institution use of AI has expanded. In light of these ongoing developments, it's important to engage the public to discuss the potential benefits of AI and the risks and other challenges that could arise with its use in our report. The report also describes the ways in which financial institutions, including banks, are already successfully addressing and managing AI use risks, with the broader goal of responsible innovation that benefits financial institutions and their customers. The Federal Reserve has been monitoring bank usage of AI for nearly a decade. We have seen a noticeable increase in the use of AI by banks of all sizes, and we've seen a variety of use cases. Our focus has been on supporting institutions that want to innovate responsibly by leveraging AI tools in their operations. Our work in the US has helped to inform the FSB's report. A central element of managing AI risks is understanding the specific use cases. In the FSB's report, we provided a variety of examples, including some in-depth case studies to illustrate the types of governance and controls that might be appropriate in similar situations. To be clear, these practices are not the only way to adopt and use AI responsibly or to manage AI risks. Another important aspect to highlight in the report is whether the use of AI is material. From my perspective, financial institutions should be specific about how they use AI and whether it is material to their business operations or legal and regulatory obligations. That actual use and materiality will help inform the type and intensity of the governance and controls that should be applied for the specific AI deployment. In the report, we emphasize that lower risk uses of AI should receive a lighter supervisory and regulatory touch. Similarly, the report also includes a significant focus on proportionality. What works or is a consideration for larger institutions using AI in complex applications is not appropriate for smaller institutions with less complex AI use cases. As I noted, our focus is on promoting innovation at financial institutions of all sizes, not just the largest ones. This report provides clear guidance to all institutions, including smaller ones. So I welcome feedback about whether the report strikes the appropriate balance on proportionality as it relates to AI adoption and use. To close, this report is an important first step as we consider how financial institutions can use AI responsibly. As you provide feedback, I encourage you to identify areas where the sound practices may be too prescriptive or where they fail to adequately account for differences in institutional size, complexity, and risk profile. Equally important, help us identify where we may not have adequately addressed material risks or where additional clarity would help institutions manage AI risks more effectively. We need to ensure that these practices support responsible innovation across the financial system while maintaining appropriate safeguards, especially for those institutions that are of higher risk. The feedback that we hear from you today and throughout the public comment period will help to inform our final report delivered to the US G20 presidency later this year. And I'm pleased with the international collaboration to this point on this work, and I look forward to improving on this in the final report later this year. And once again, I'd like to thank Hern-Chin Ho for her leadership in moving this work stream forward in such an incredibly expedited fashion. So thank you to the Secretariat and to Hern-Chin for your leadership.
Thank you very much, Vice Chair Berman. Can we turn to Hern-Chin, please?
Yeah. Thank you, Mickey. And very good morning, good afternoon, good evening to everyone joining from different parts of the world today. Welcome to this virtual event on FSB's consultation report on sound practices for financial institutions' responsible AI adoption. As Vice Chair Bowman mentioned in her opening remarks, along with experts at FSB member authorities, we have put together this consultation report to facilitate responsible AI adoption and use at financial institutions. The report also drew from inputs from our private sector engagements, and I would like to take this opportunity to thank those who kindly took part in the preliminary discussions with the FSB. Today, we are joined by a truly diverse and global audience, reflecting the interconnected nature of the financial services landscape. It is wonderful to see participants representing countries across 6 continents and a wide range of sectors and professional backgrounds. These include central banks, financial supervisors, banks, insurance companies, asset managers, international organizations, consultants, technology specialists, and academia. I'm confident that this diversity will enrich our conversations today and ensure that the responses to the consultation are informed by a broad spectrum of perspectives and expertise. In my presentation, I'll briefly cover what are the sound practices that the FSB has put out on consultation, why they matter, and how you can provide feedback. Across the financial sector, AI adoption is accelerating. Financial institutions are using traditional machine learning, large language models, and increasingly agentic AI to transform business models, business processes, and their customers' experiences. These benefits are real, but they also introduce or amplify risks. The FSB's aim is straightforward: to help financial institutions harness AI's benefits and opportunities while managing its risk responsibly and in ways that support the resilience of the financial system. We are currently consulting on a menu of 12 sound practices. These are non-prescriptive and they are intended as a practical reference for financial institutions, particularly for boards and senior management, as they consider AI governance and risk management practices for the institutions that they lead. These sound practices are also broadly compatible with existing work by the FSB, other standard-setting bodies, and national authorities. They are not, I would emphasize, they are not an international standard, and they will be subject to change as the technology evolves. Can we have the next slide? Thank you. The 12 sound practices, and then the next one, Shah, sorry. So the 12 sound practices falls into two groups as listed on this slide here. The first 4 sound practices relate to organizational-wide AI governance, and the remaining 8 sound practices relate to different aspects of an AI lifecycle management. Together, they emphasize that AI risk should be managed not only at the individual use case level, but across the enterprise through effective governance, robust risk management frameworks, and clear accountabilities. Next slide. In applying the sound practices, financial institutions should bear in mind a few considerations. First, the sound practices are applicable to all types of AI, although there will be some more detailed practices that may be more important for specific AI approaches. Second, as AI technology is evolving rapidly, these sound practices are subject to change. Third, the sound practices are to be applied in a proportionate manner. Financial institutions differ by their business model, complexity, size, and interconnectedness, and each AI use case differ in materiality and risk. For lower risk, low materiality applications, more streamlined processes may be adequate. As materiality and risks arise, especially where AI touches critical operations or customer outcomes, more robust governance and controls would be appropriate. The report also includes case studies drawn from real-life implementations. These provide texture, context, and nuance on how the sound practices are actually being implemented by financial institutions of different sizes and maturity across the financial sectors. These would, we hope, help financial institutions better appreciate how the sound practices are practicable in real life. It is true that many of our use cases currently in the report relate to banks, especially large or internationally active banks. The FSB therefore would welcome inputs from smaller banks, insurers, asset managers, and other non-banks during the public consultation period to enrich our case studies. Next slide. Now, for the detailed contents of the report. Section 1 of the report provides an overview of AI use cases in the financial system, including their benefits and challenges. AI adoption varies across entities, sectors, and jurisdictions, with more advanced use cases seen generally among the larger and more internationally active financial institutions. Across the financial sector, AI is generating tangible benefits. In credit scoring and underwriting, AI use has improved risk assessments and in some cases, broadened access to financial services. In trading and asset management and portfolio optimization, AI has helped to improve real-time market modeling and analysis. In regulatory compliance, AI has helped to strengthen fraud detection controls. In customer engagement, AI-powered robo-advisors support planning and portfolio rebalancing, while conversational tools enhance services to customers. Next slide. Alongside benefits, of course, the report highlights key challenges under Section 1 still, and the risks to manage with AI adoption. These span governance, data quality issues, explainability challenges, poor AI performance, inadequate human oversight, cyber and ICT risks, third-party dependencies and concentration risks, as well as consumer protection and market conduct concerns. A few of these are worth highlighting. Cyber and ICT risks, third-party dependencies and concentration risks are challenges that we hear frequently about as financial institutions scale their AI adoption and rely more heavily on external providers. For example, providers of cloud infrastructure, hardware, and AI foundation models are often highly concentrated and in some cases vertically integrated, making concentration risk from third-party dependencies an area that warrants careful monitoring and management. The report also gives particular attention to the risk posed by agentic AI, where its autonomous nature can amplify certain risks, such as unauthorized actions and data breaches at speed. Managing these risks effectively is key to ensuring that AI adoption delivers sustained value for financial institutions. Next slide. Let me now briefly describe each sound practice under sections 2 and 3 of the report. We start with the first 4 sound practices on organizational-wide AI governance. AI governance concerns how financial institutions choose, monitor, and periodically review their approach to AI adoption and organizational governance. Sound practice 1 highlights that the boards and senior management play critical roles in setting a clear direction for AI adoption and in providing senior-level oversight. Boards and senior management ensure that AI adoption and governance align with the financial institution's business model, risk appetite, and strategy. They ensure that financial institutions are appropriately resourced to support AI adoption and ongoing effective management of the associated risks. Sound practice 2 relates to governance and accountability. The board and senior management are also responsible for establishing and maintaining clear and defined roles and responsibilities across the organization with respect to AI adoption. They consider the most appropriate operating model for AI governance, whether centralized, decentralized, or hybrid. They establish cross-functional coordination so that AI-related decisions within the organization are informed by diverse expertise and perspectives across the organization. Next slide. Building on these 2 sound practices, sound practice 3 focus on incorporating AI risk considerations into existing risk management frameworks and maintaining accurate documentation of AI use cases. Finally, sound practice 4 is about establishing appropriate organizational culture for financial institutions to continually learn, adapt, and adjust their oversight, governance, and risk management practices, and their overall approach to AI adoption as the technology evolves. This includes building AI literacy for all staff, deepening specialist skills, and fostering a risk-aware culture by learning from incidents and near misses, whether within or outside the organization. Financial institutions also keep abreast of technology developments and on users of AI by engaging across the industry and with authorities. Next slide. In addition to establishing organizational-wide AI governance, Section 3 highlights sound practices 5 to 12 that covers financial institutions' management and mitigation of AI risk at different stages of AI development and deployment, or colloquially we say AI lifecycle. While there is no standard one-size-fits-all AI lifecycle, the report uses 7 illustrative stages: inception, design and development, verification and validation, deployment, operation and monitoring, re-evaluation, and retirement. Financial institutions can adapt this to their own environments. The key is to apply proportionate guardrails at each stage so that risks are identified early and managed well continuously. Next slide. Sound practice 5 relates to materiality and risk assessment. Materiality looks at how important the AI use case is to a financial institution's viability, critical operations, and legal obligations. Risk looks at what could cause harm. And remember, low materiality doesn't always mean low risk. For instance, if an AI has access to sensitive data. Therefore, it is prudent to assess both materiality and risks. Sound practice 6 is about the selection of AI models or systems. Financial institutions may decide to build in-house, buy from third parties, or adopt a combination. In selecting the AI models or systems that fit their use case, financial institutions will find it useful to consider various factors and weigh trade-offs. For example, a simple, more explainable model with a slightly poorer performance may in some cases be preferred over a higher performing model with greater complexity, higher costs, and lower transparency. Next slide. Sound practice 7 covers data governance, as this underpins effective and reliable AI. Here, financial institutions establish frameworks to maintain data that is fit for purpose for training, for testing, and for using AI. They manage the different stages of AI data use, from initial assessment of whether to use internal data, public data, or data from third parties, to post-deployment monitoring to identify and remediate problems such as data drift. Where financial institutions rely on third-party data or models, they conduct due diligence on their data governance and quality controls and deploy compensating measures where visibility is limited. Sound practice 8 is about explainability and transparency. It is important to understand differences in explainability across different AI types. Where appropriate and feasible, financial institutions select more explainable approaches or consider compensating controls, such as stricter limits on permissible use cases, benchmarking, challenger models, sensitivity and stress testing, more extensive validation, and increased human oversight. Alongside this, appropriate transparency is provided to different stakeholders, including audit functions, supervisors, customers, and end users where AI materiality influences outcomes. And this may be tailored depending on stakeholder needs. Next slide. Sound practice 9 outlines performance management. This includes evaluating AI performance proportionately to the materiality and risk of each use case across key dimensions such as accuracy, robustness, stability, and the expected range of outputs, with thresholds set in advance where possible. This covers developmental testing, such as for overfitting and unacceptable bias, as well as ongoing monitoring for performance degradation and drift after deployment. The report acknowledges that performance assessment can be more challenging for generative and agentic AI and sets out additional considerations for financial institutions to bear in mind. Sound Practice 10 entails implementing meaningful human oversight that is relevant to the materiality, risk, autonomy, complexity, and explainability of different AI use cases. This covers how to design and select appropriate forms of oversight, such as human in the loop, human on the loop, human in command, or even AI in the loop, and how to set clear responsibility for human oversight throughout the AI lifecycle. Sound Practice 10 also sets out additional considerations for generative and agentic AI, such as assigning and documenting individual identifiers to AI agents and placing boundaries on AI agents given the distinct oversight challenges that they present. Next slide. Sound Practice 11 focuses on evolving financial institution, cyber, and ICT risk management to address AI-enabled threats while harnessing AI-powered defenses. This includes understanding and monitoring AI-related cyber and ICT risks, incorporating AI-specific cyber and ICT risk scenarios into their tests and exercises, and collaborating and sharing relevant information with key stakeholders. It is worth noting that the sound practices in the report were not developed to specifically address recent risks that have emerged related to the use of frontier AI models in cyber attacks. Although some sound practices, I would say, such as Sound Practice 11, would help financial institutions respond to such risks. Finally, Sound Practice 12 covers third-party AI risk management, which builds on existing FSB third-party risk management guidance. It emphasizes the importance of conducting proportionate due diligence and ensuring appropriate transparency through tools like model or system cards, certifications, and contractual rights for access, audit, and information. Planning for continuity, data portability, exit strategies, and managing concentration risks across the AI supply chain is essential. In cases where transparency is limited, compensating controls and contractual safeguards provide additional layers of protection. Next slide. So this is a public consultation and your input is invaluable. We invite your feedback by the 22nd of July through our secure online form. We're particularly keen to hear your thoughts on several key areas as described in 7 consultation questions as set out in this slide. As mentioned earlier, we welcome case studies from across different types of financial institutions, including smaller banks, insurers, asset managers, and other non-banks to help enrich the report. Responses will be published unless you request otherwise, and you can contact the FSB Secretariat by email if you have questions or if you wish to provide supplementary material beyond what the form allows. In closing, the sound practices combine organizational-wide governance with AI lifecycle management to be applied in a manner that is proportionate to materiality and risks. They are intended as practical, non-prescriptive practices to support responsible AI adoption and to reduce risk to financial stability. I look forward to your questions and to your feedback this evening and through the public consultation. Thank you very much for your time and for your perspectives. We will now turn to the discussion portion of today's event, and it will be conducted in 3 parts. First, we will hear preliminary views on the consultation report from 3 private sector speakers who have kindly agreed to join us today. Second, we will discuss key themes from the questions that were shared in advance from attendees via the online registration form. Third, we will open the floor to any additional questions or comments, and you can participate by raising your virtual hand or sharing your comments in the chat. So to get us started, I'm pleased to say that we have three excellent speakers joining us today. We have Ida Filipovic, Managing Director, Responsible AI Lead at Citi, Jeff Valence, Group Head of AI Management and Strategy at HSBC, and Valeria Yespenko, Vice President, Enterprise Data Governance at Manulife. We'll start with Ida to kickstart the discussion. Ida, over to you.
So first of all, from our perspective, this consultation report is not only thoughtful and comprehensive, but also really truly welcome contribution to the global dialogue on AI across financial services. We feel it represents a very significant stride towards creating a structured but adaptable framework for responsible AI adoption. At the outset, I'd like to state our strong support for the report's core approach, in particular commend the framing of these sound practices as principles-based and outcomes-focused, rather than being overly prescriptive, which clearly aligns with our own approach for embedding AI responsibly across our operations. Secondly, proportionate and recognizing that the risk management must be calibrated to the materiality and the specific risk profile of each AI use case. The sheer range of use cases we see every day clearly means that we need a nuanced understanding that is crucial to practical implementation. And importantly, or probably most importantly, that it is technology neutral, which gives us the flexibility for institutions such as Citi and our peer banks to innovate responsibly, but also at speed, because these powerful technologies continue to evolve in what can only be described as a breathtaking pace. So from a Citi perspective, clearly we have very diverse operations which span everything from retail banking to institutional services, wealth management, across countless markets. So understanding the need for innovation and ability to innovate is something we care deeply about. So we must innovate not just for competitive advantage, but also to meet the ever-increasing demands of our global customers, to continuously enhance the efficiency and resilience of our operations, and actually possibly most critically to defend the financial systems against the increasingly sophisticated and rapidly evolving threats, particularly in areas like fraud, cybersecurity, and market manipulation. So, and the recent explosion of powerful frontier models makes this more apparent than ever. The models are fundamentally transforming the pace and sophistication of everything from internal process automation to our cyber defense capabilities. And for firms with any global scale and reach, as well as interconnected businesses, in order for us to remain resilient and compliant and competitive, we must be able to adopt and adapt these new technologies safely, securely, and with robust governance. We believe that the overarching goal of any AI framework must be to strike a truly careful balance, which is to permit and encourage responsible AI adoption within a clear and intelligently risk-adjusted guardrails, but not inadvertently stifle the very innovation that is essential to the safety and soundness of the global financial system. We do believe that the FSB report has set exactly the right tone for achieving this critical balance. So with that vision of a durable, balanced future in mind, I would like to pivot and dedicate the remainder of my time to highlighting a few specific pressing challenges that global financial institutions like Citi would like to explore further with both our peers, but also the regulatory community. First of all, I've already said we are a very global enterprise across 160 countries and jurisdictions, complex product offering, of diverse regulatory requirements. So we possess a unique vantage point shared by some of our other peers on the rapidly evolving international regulatory landscape for AI. So we fully recognize that different jurisdictions will, and actually should, naturally tailor their approaches to reflect local legal frameworks, cultural nuances and priorities, but acknowledging also the varied stages of AI adoption and impact across these across the geographies. However, AI technology is inherently global and borderless, so it impacts interconnected financial markets in a meaningful way. For us, we believe this presents a significant opportunity to foster greater consistency across these emerging frameworks. Without a foundational degree of international alignment, we have a genuine risk of fragmented regulatory requirements and divergence in key areas. So even if we think about something that is quite simple as a slight difference in a definition of a core concept like agentic AI or materiality, down to having widely varying supervisory expectations on governance, data privacy, risk management, for any institution which operates in a global context across jurisdiction, this fragmentation would create not only operational complexities, but more importantly, would needlessly slow the adoption of the beneficial risk-reducing AI technologies across the entire financial system. So we believe that leveraging these sound practices as a robust foundation for a more harmonized global framework will be key. And fostering the consistency will not only promote the safe and responsible adoption of AI, it will fundamentally strengthen the resilience of the entire financial ecosystem, which is clearly a goal that we all share. So we're committed to supporting the FSB and our global regulatory community in this important work, and working together to ensure that these high-level principles are applied consistently, intelligently, and without becoming overly prescriptive in practice at the national level. With that, I'd like now move to cover a couple of areas, that first one being one that I know keeps many of us in financial services awake at night, which is the third-party risk in the context of AI. We clearly welcome the report's focus on this area and its inclusion as one of the 12 sound practices. And looking at Citi, like many of our peer institutions, which with reliance on a vast ecosystem of technology partners, with a global service delivery model, we recognize that managing this complex and rapidly evolving AI supply chain is far more than just another risk category. It's arguably one of the most significant and systemic challenges facing the entire financial industry today. And the sheer scale and intricate complexity of this issue, involving multiple layers of vendors, sophisticated technologies, are absolutely immense and warrant an even greater focus and deeper concerted consideration from the international regulatory community. The undeniable reality is that foundational models, the very building blocks that all of our AI is being built on, and the underlying infrastructure they run, are currently developed and controlled by a very small number of highly powerful non-financial technology providers. And it is this market dynamic which creates an unprecedented level of systemic dependency across the industry. So we don't think about this as just a third-party vendor risk. It's a fundamental financial stability risk with direct implications for operational resilience. When much of the global, and if we roll forward 12 months from now, 2 years from now, when the adoption of AI, if it continues at the pace and scale it has been going so far, and much of the global financial system relies on the same few providers, an outage is no longer an isolated incident. It becomes a source of sector-wide correlated disruption. So, and the notion of a seamless or ability to seamlessly switch from one provider to another is often operationally unrealistic, given different AI models require extensive calibration testing prior to deployment. So this creates a systemic vulnerability that directly relates to the financial stability mission of the FSB. And it is this fundamental challenge of concentration, which is then compounded by the opacity of the deep supply chain. So with AI being infused through virtually every layer of the supply chain, critical risks cannot originate from fourth, fifth, even nth party vendors, which are entities far beyond any single financial institution's reasonable scope of direct visibility or control. Expecting downstream firms to bear the entire burden of validation and oversight is simply not practical, not scalable, and is ultimately ineffective at addressing the root cause of the risk. So we were particularly encouraged by the FSB's reference to an AI shared responsibility model, And it is this concept that can be extremely useful in building a sustainable and equitable governance framework for AI, and a formal acknowledgement that accountability must be appropriately distributed across the entire AI supply chain, from the upstream developers of foundational models to the downstream firms like ourselves that deploy and operationalize AI-enabled services. So to truly make this work, we do see parallels with how regulators have successfully approached other systemically important parts of the financial ecosystem, so cloud service providers or financial market infrastructures. So the question we should be asking ourselves is, are AI providers now, or will they become a tipping point, particularly those developing foundational models, actually evolving into a new form of critical infrastructure? And if that is the case, then the systemic risks like concentration should be proactively addressed at the source and not just at the level of the individual firm. Moving on to the next area, which is how do we navigate new frontiers posed by agentic AI in particular? And the report adeptly identifies that emerging technologies such as agentic AI are introducing entirely novel risk vectors. And the sheer speed at which these capabilities are evolving means that there is a significant degree of shared uncertainty across both us in the industry as well as the public sector. So for this reason, we absolutely appreciate that the Sound Practice 4 explicitly addresses the need to adapt our oversight and governance as AI evolves. And quite frankly, this is truly uncharted territory for all of us. No single entity, neither industry nor regulators, currently possessed a complete understanding of the full spectrum of risks involved, nor the most effective and efficient ways to mitigate them. So we would strongly encourage the FSB to foster and promote a robust public-private collaboration on this topic. This collective effort is essential to us developing a shared, nuanced understanding of the new technologies, and it is vital that we avoid premature or overly prescriptive regulations in areas like agentic AI before we collectively truly understand its true capabilities as well as the evolving risk dynamics, and actually have more examples which are tested in real-world scenarios. This naturally leads me to the critical topic of human oversight. And again, we do commend the FSB for its insightful recognition that human oversight is not a monolith, and appreciate the clear distinctions drawn between the different forms it can take, such as human in the loop versus human on the loop. And it is this nuanced perspective that is critical. It acknowledges that simply increasing human oversight is not always the optimal or the most effective strategy to address AI-related risks, especially when dealing with highly autonomous, high-speed systems deployed across a global network. So for instance, requiring a human to manually approve every single action of an agent, which is operating at machine speed, processing thousands, if not hundreds of thousands of actions per second, is not only impractical and unsustainable, it would create severe bottlenecks that negate the very benefits of automation. And actually worse, it may not even be the most robust and reliable control mechanism. Instead, we at Citi advocate for evolving our thinking about oversight to encompass new, more sophisticated forms of assurance. So for example, developing robust real-time observability and continuous automated monitoring to ensure that the AI agents operate strictly within their intended boundaries, and focusing on building intelligent guardrails, precise performance metrics, and fail-safe kill switches that allow us to maintain human accountability for the system's outcomes without a human having to manually gate every intermediate step. So in closing, let me just reiterate the Citi's unequivocal support for the FSB's vital work and the visionary direction set by these sound practices. We're absolutely confident that this report provides a very powerful and pragmatic foundation for the responsible global adoption of AI. The challenges we've explored today, from navigating the complexities of a concentrated supply chain to ensuring appropriate human oversight, are clearly and undeniably complex, dynamic, and shared across the industry. So addressing them effectively will require deep, sustained, and genuine public-private partnership. We're fully committed to this collaborative effort and very much look forward to engaging constructively with our peer firms as well as FSB, and the regulators and policymakers globally. Thank you very much.
Thank you very much, Ida, for your insights. Those are very helpful. Thank you for unpacking some of the key risks, such as systemic level type of concentration risk. We're aware of that. Thank you for also suggesting how regulators can work closely with the industry as well to support the next useful steps forward. Thank you. We'll now move on to Jeff. Over to you.
Thank you. Thank you for convening this. I'm delighted to be here with you. For those that don't know me, I'm Jeff Filane, Group Head of AI Management and Strategy at HSBC, and I'm tasked with accelerating the commercialization and responsible adoption of AI across the group. I just wanted to say at the outset that we strongly support the FSB's direction of travel. Outcome-based, proportionate, technology-neutral approach is the right one. Given the pace at which AI is evolving and faster than any checklist can actually keep up. Recognizing that across financial services, we're all at different points of maturity in developing and deploying our AI, but what we all share in common is our desire to do so responsibly, while also seizing the opportunity to innovate and compete, provide better products, services, and experiences to our customers and clients. And completely recognize that regulatory authorities as well see the tremendous benefits that AI can offer, which of course must be balanced against the risks that it does present. And so in the FSB developing a principles-based approach, proportionate, technology neutral, we're very much aligned with that, ensuring that AI is adopted responsibly, consistently across the world, and minimizing fragmentation. So I wanted to focus on three practical themes that I think are core to being able to achieve this. The first is around making sure that we have proportionate, globally implementable governance that leverages existing financial services regulation and governance, and that is anchored in use case materiality and autonomy. The second is around recognizing the role with which agentic AI is changing what meaningful oversight means in practice in terms of speed and scale. And the third, as Ida mentioned, I'll double click on as well, around third party and concentration risk and what that looks like across the AI supply chain and the importance that it's addressed as a core financial stability issue. So on the first bit, proportionality, globally implementable governance that leverages existing governance and regulation anchored in use case materiality and autonomy. So really appreciate the separation of enterprise governance and the sound practices. I think it's 1 through 4 versus the life cycle controls 5 through 10, and then the cyber cross-cutting ones 11 through 12. They're all very practical and implementable. So we very much enjoyed reading those. We support the emphasis on proportionality, that a one-size-fits-all approach on a per-use case basis does not work, and that there needs to be clear, critical materiality thresholds and functions, and that when we look at a risk tier effectively by use case, and we look to proportionate governance and risk management for those different areas, and simultaneous that we look to leverage existing governance structures and processes where possible, rather than building separate and distinct parallel AI governance and risk management controls and processes. So as we think of anchoring AI governance in this way, it enables factors such as materiality, degree of autonomy, systems data access, customer market impact, third-party dependency, effectively allowing for this kind of strong and comprehensive risk management without having to discern, gee, is this Gen AI, agentic AI? You can have a much more globally consistent approach and model that applies to all based on those kind of discrete areas and thresholds. It also enables iterative control updates based on incidents, near misses, vendor model changes, something that we know the FSB would enjoy and perhaps could explicitly encourage. The FSB could usefully define materiality and criticality. We encourage it to make explicit those thresholds, and perhaps even explicitly leverage existing frameworks rather than create net new ones. There's a number in place that are pretty good and pretty strong that will help reduce the global regulatory fragmentation and streamline implementation across the globe. The second area on operational resilience, cyber, and what like meaningful oversight looks like. So recognize that governance being risk-tiered and scalable, another central element is in fact cyber resilience, incident handling, robust oversight. We're all tracking a lot of the developments that have come from the US and availability of Mythos and Fables and export controls, and the importance by which cybersecurity will continue to play a role in the way that we all kind of function and operate. These controls must be designed for speed, autonomy, and interconnectedness while keeping accountability crystal clear. So the FSB, so in terms of sound practice 11, adapting and enhancing existing cyber ICT practices, very much in line with that. We feel that the threat taxonomy in the report is correct and relevant, such as accelerated vulnerability discovery, poisoning, prompt injection, and the menu of oversight patterns in Sound Practice 10 is pragmatic, such as human in the loop, human on the loop, and human in command. And as the report notes, where agentic changes the game is the impracticality of real-time human monitoring at scale, and the potential need, likely need, for machine monitoring while retaining accountability. So this is exactly where we think we should continue to focus the dialogue and think through exactly what meaningful oversight looks like with that human on the loop and human in command structure. And being much more opinionated on what that could look like. We would also encourage a posture of test, learn, adapt, and keep the framework flexible as norms mature. The third area around third-party dependency, not to belabor Ida's points, but it's critical. As we look across cloud, hardware, foundation models, data providers, and platforms, we continue to see vertical integration and geographic concentration, which again is something that we should really continue to track and monitor. The paper also flags herding and cyclicality risks in many forms, and many firms rely on common models, data sets, infrastructures to be able to support these models. I'd say that even grows as well as the use and availability of these models expands beyond areas like financial services and into the mainstream retail markets. That type of herding and concentration continues to be even more manifest. And so what the industry needs in practice are workable expectations, including around change notification. So when vendors swap, upgrade underlying models, vendors' use of shadow AI, and audit information rights and assurance tools. Most importantly, what both the industry and regulators need is better systemic information and insight. Systemic risks of AI can only really be understood by regulators, and they will need sufficient information directly from critical third parties, not only from those regulated financial service firms. So just a quick summation in kind of two areas where I think we should tailor and focus the conversation. So in summary, I believe the FSB has broadly landed on the right architecture here around governance, lifecycle controls, cyber, third party, scaled by proportionality. The most important refinement is around ensuring the final report remains outcomes-based, avoids de facto prescriptive requirements, and squarely looks at addressing cross-border consistency and concentration systemic efforts. And as discussed, the two areas where it'd be good to further discussion are really around materiality and practice. And so what is that minimum set of criteria that we should align on internationally to assess use case materiality so global firms can implement consistently without stifling lower risk innovation and trying to track ambiguously phrased and inconsistent, unaligned, the risk and materiality thresholds across the globe. and the second being around concentration and correlated behavior. So what concrete cross-firm or sector-level mechanisms would enhance systemic oversight and most effectively mitigate systemic risk from reliance on a small set of AI supply chain providers. So with that, thank you again, and appreciate any questions that we may have later on.
Thank you very much, Jeff. That was very useful. We'll move now to Valeria for your insights. Over to you, Valeria.
Hello, everyone. First of all, thank you very much for the opportunity to participate in this consultation. I represent Manulife. My name is Valeria Yesipenko. I lead AI and data governance for Manulife. I will start by introducing Manulife here. It's a leading international financial services provider that offers insurance, wealth management, retirement solutions to millions of customers across Asia, Canada, and the United States. To begin and open my statement talking about the paper, we found that the paper strikes a thoughtful balance between fostering innovation and maintaining a strong commitment to responsible AI adoption. The paper presents these goals as complementary objectives that can and should advance together rather than as competing priorities. At Manulife, commitment to be an AI-powered organization is an inherent part of our strategy. Our advancement in the adoption of AI has been recognized by industry rankings. In 2025, Manulife was recognized by Evident as #1 life insurance company for AI maturity and ranked in the top 5 insurance overall. To begin my commentary, I want to acknowledge the work that has gone into this report. AI is evolving incredibly quickly, and one of the challenges for both industry and regulators is that we are all trying to build our understanding and governance approaches while the technology and our understanding of risk continues to change. Overall, many of the themes resonate strongly with what we have been building at Manulife over the last several years. AI is now being used across underwriting, claims, distribution, customer service, investment management, and software engineering. We're seeing tangible value for customers, advisors, and colleagues. Our approach is anchored in our 6 responsible AI principles, covering ethical alignment, safety and governance, sustainability, reliability, explainability, human agency, and continuous learning and collaborations. Those principles guide how we design, develop, deploy, and monitor AI solutions, regardless of the underlying technology. Collectively, these principles underscore Manulife's commitment to responsible AI adoption, a central theme for the FSB report. Now, let me highlight several themes that resonated the most with us. And I think I'm following my colleagues. I'm not alone in highlighting the themes that stood out the most. So proportionality has been mentioned several times, and we echo that. Not every AI use case presents the same risk profile. There's a significant difference between a colleague productivity tool helping draft internal content and an AI use case involved in underwriting, claims decisions, or customer outcomes. At Manulife, we build governance structures, model risk management practices, and oversight models that scale according to materiality and risk. That approach has been critical in allowing us to innovate while maintaining appropriate controls. Our model risk framework today includes differentiated requirements for traditional AI, generative AI, and increasingly agentic AI, with oversight scaling based on materiality and customer impact. As supervisors and institutions continue to mature these approaches, it will be important to ensure that well-intentioned governance does not inadvertently create friction for lower risk use cases without meaningfully improving risk outcomes. Another area where we strongly agree with the report is the emphasis on data governance. In many ways, responsible AI starts long before model development. We experience how data quality, stewardship, and access management controls impact the quality and trustworthiness of AI outcomes. For those reasons, we believe that the foundational investments in data are as important as the sophistication of the model itself. Accordingly, as FSB correctly underscores, for organizations looking to move from experimentation to scaled adoption, data governance is not just an enabler of AI, it's a prerequisite. Now I would like to spend some time on the themes that require continued discussion and further guidance, and I will begin with human oversight. Human oversight is clearly important, but the industry needs to develop a more practical approach to maintaining human agency and accountability. And again, it was mentioned both by FSB and by my colleagues here that there are different ways and alternatives to a human reviewing every outcome. In practice, it can take many forms. It can happen through governance, testing, escalation protocols, exception management, and ongoing monitoring. I'll give you an example of a use case at Manulife that we have implemented for our Canada operations. We call it MOD. It's an AI-powered underwriting engine. For low-risk, straightforward applications, MOD can provide an approval decision in as little as 2 minutes. At the same time, more complex or higher-risk cases are escalated to an underwriter for additional assessment. Human oversight is achieved not by reviewing every automated underwriting decision, but through meaningful escalation pathways, directing cases outside defined parameters to qualified underwriters for review. That approach allows us to improve speed and customer experience while maintaining accountability and appropriate controls. I think it's appropriate to continue to explore these alternative approaches that are both efficient and often more effective than human reviewing every decision. Another complex topic is explainability of AI models. As a financial institution, we absolutely recognize the importance of explainability. However, with Gen AI and agentic AI in particular, explainability is rarely a binary concept. Some of the most valuable AI capabilities available today may not be the most inherently explainable because of their probabilistic nature. But even when we cannot readily explain how the model arrived at each individual conclusion, we can build trust with the help of proper governance, validation, and monitoring of outputs. It's helpful to consider a broader control environment as a path to explainability. Next, let's talk about third-party risk. Again, a theme broadly highlighted today. The report correctly identifies it as one of the most challenging issues facing the industry. Financial institutions are not only building their own AI capabilities, but relying on cloud providers, foundational model providers, AI platforms, and software vendors. While these institutions remain accountable for outcomes, many are asking similar questions of the same providers. So there's likely an opportunity to reduce duplication while improving transparency and consistency across the sector. And it would benefit from continued work on standardization of disclosures, model documentation standards, assurance mechanisms, and shared responsibility models, as was highlighted in the report. As a final theme, I'd like to discuss agentic AI and the emergent challenges it brings. With rapid technological advancements, we're moving beyond models that generate content towards systems that can plan, reason, orchestrate tasks, and increasingly interact with operational processes. At Manulife, we see significant potential in agentic AI, and we recently announced partnerships with Adaptive and ACA to support the next generation of our global enterprise platform to support agentic AI capabilities. What attracted us to these partnerships was not simply technology innovation, it was focused on safety, operational resilience, the ability to deploy AI sustainably, and embedding of governance and controls a priori, not as an after-the-fact effort. We view these capabilities as embedded in the development lifecycle from the outset. This way, we can scale with confidence. We would very much welcome further discussion and guidance from FSB related to agentic AI adoption and the frameworks to safeguard and secure these autonomous AI systems. Stepping back, I would like to acknowledge that FSB has done a very good job of grounding the conversation in practical governance, highlighting the importance of data and proportional treatment of AI risk. It also brings up important themes of explainability, third-party risk, and emergence of autonomous AI systems that require further elaboration and focused discussion. AI is evolving incredibly quickly. Companies must keep pace with the change and innovation to maintain their competitive edge while balancing that with the proper governance and risk management. That's why this dialogue between the industry and the regulators is essential and timely. And once again, I want to thank you for the opportunity to be a part of it.
Thank you, Valeria, for your comments, and thank you to all speakers for sharing your rich insights. Many of you shared what you appreciated about the report, the risk proportionate approach, the non-prescriptive approach, the technology neutral approach, and the fact that risk management considers not just risk management at the individual use case, but also at the organizational wide level. Of course, many of you also raised issues that merit further discussion, and you'd be keen to continue your dialogue with your regulators as well as with FSB. Issues such as third-party risks, which I think Ada reminds us, and I think Jeff as well, that this cannot be solved at the individual financial institution level. Supervisors do need to take a look closely at the concentration and third-party risks that will emanate from adoption as it scales, and that continued conversation will be very important in this area. Of course, the other areas that merit further conversation are human oversight, particularly in the world of agents, AI agents. There's also a call for whether there can be more consistency in approaches across jurisdictions. I think FSB has made a step at this in the right direction. We will see how we can continue to crowd in more partners into our conversation so that we can be walking along a more aligned path. So thank you very much for your comments. We will now move over to the next section of this discussion section, and that would be the questions that some of the participants have submitted online. Our focus will be on the broader thematic questions related to the report. While some jurisdiction-specific questions have been raised, such matters are in fact best addressed by the relevant national authorities. We will thus not be delving into those. After this segment where we talk about some of the pre-raised questions, we will then open the floor up for other questions and comments. To assist with this discussion, some of the FSB member experts who have contributed significantly to the report will also join me in responding to views raised from the floor. They are Simona Galina from the Bank of Italy, Gechu Go from the Monetary Authority of Singapore, Anna Garcia from the Office of the Superintendent of Financial Institutions, Canada, Annika Schumann from the Swiss Financial Market Supervisory Authority, David Palmer from the US Federal Reserve Board, and Orlando Fernandez-Ritz from the Bank of England. As usual, Yasushi, Sheena, and Shaz Gite from the FSB Secretariat will be on hand to answer procedural questions. I would also encourage the three speakers to please jump in with added perspectives from your practical experience of implementing AI in your respective organizations. So let's start with questions submitted in advance of this event. The first question is, should firms view the current sound practices as sufficient for agentic AI or primarily as a baseline? I will make a first attempt to answer this, and I'll invite the rest to jump in with your comments after. Well, the report identifies sound practices for responsible AI adoption, including the adoption of agentic AI. However, it is not intended to be exhaustive, nor is it intended to set a minimum standard. Financial institutions, as you heard from the various speakers, are meant to apply the practices proportionately, taking into account materiality, risk, complexity, autonomy of the AI use case, and the FI's context. So this may involve supplementing the sound practices with additional controls where appropriate, or streamlining some of them in low-risk, low-materiality cases. For agentic AI in particular, many speakers have also noted that this space is advancing rapidly, and new sound practices are emerging and taking shape rapidly as well. We therefore welcome the industry to give us feedback on additional practices, controls, or case studies that could be reflected in the final report with respect to agentic AI. I would like to see if David, please.
Yes, thank you so much. Can you hear me okay?
We can hear you, we can't see you.
Yep. Okay. Thanks. Yeah, I just want to underscore your comments, particularly and comments from the panelists that we are still sort of understanding the full distribution of risks related to AI agents. And so we're all learning. What we've observed is that institutions are taking a careful approach to try to learn through testing and sort of more careful, more controlled application to see what results can be. As we all know, financial services has experience with agents of many different kinds already over the years. What can be different with AI-related agents is some of the unpredictability or stochastic nature of them. And so that is sort of a new element that is thrown in, whereas institutions may have more experience with deterministic agents. So I think we're all learning, and so I think that's a key theme of the report. Thank you.
Thank you. Would any others like to jump in on this? Okay, hearing none, let's move on to the second question, but please do feel free to jump in later on if new insights come to mind. So the second question is, as AI increasingly governs AI, how do we preserve clear human accountability? I'd like to ask either David or Orlando to answer this question. Orlando, please.
Hi, good morning. Hopefully you can hear me. If not, see me. Hi. So thank you very much. So this is a very very interesting question. In the report itself, and I think this has been called out by other kind of lead discussants. We acknowledge that agentic AI, because of its high levels of autonomy, poses some unique risks to financial institutions, particularly as its adoption grows at scale. And clearly, effective human oversight is and will continue to become critical in terms of managing these risks. But one of the things that we notice is that in a lot of the existing literature and industry discourse, it often gets oversimplified. It gets to reduce to notions like humans in the loop, etc. One of the things we try to do with Sound Practice 10 is to actually identify a list of different kind of non-mutually exclusive forms of human oversight that financial institutions can leverage, particularly as agentic adoption increases at scale. And those include AI augmented oversight. I think that we generally recognized, and I think this was validated in a lot of our pre-consultation discussions with industry, that as agentic deployments increase at scale, it becomes impractical and impossible in many instances to have one human overseeing on a full-time basis the actions of agents. So we wanted to just kind of emphasize the need for kind of augmentation through technology of human oversight capabilities moving forward. Having said that, obviously accountability is a well-established concept, is quite immutable, and it's something that we've dealt with in the realm of other related areas like third-party risk management. Accountability does remain forcibly with the institutions and the senior management. There are obviously kind of questions about how it's discharged and how it's executed, and of course there will also be, if you're relying on third parties, contractual agreements that govern the apportionment of accountability in different situations. But nonetheless, the delivery of financial services is something that financial institutions by definitions remain accountable for. But we wanted to recognize that at this point in time, there are existing and emerging different tools that firms can deploy to make human oversight more realistic and scalable. And of course, this is an area that's going to continue evolving. I think I would probably invite industry to consider what nascent or emergent forms of human oversight that deliver the outcomes that are intended in the report might be emerging that we may have missed out on, because this is something that will very likely risk getting out of date very soon. Thank you.
Thanks, Orlando. Would any of the lead discussants or other workstream members like to chime in? Okay, if not, let's move on to the
Maybe
third
I'll.
question. Yes, please, Jeff.
Yeah, just
You have
to
the floor.
kind of, yeah, thank you. Maybe just to add, so it goes back to kind of the importance of proportionality when you're thinking through the impact of these AI systems. And so having that proportionality and risk-based approach is super critical, as well as the appropriate technology and control solutions and frameworks to be able to manage and monitor in a post-production world. Historic model risk management and other type approach have really emphasized the pre-production requirements on risk management, where as we look at kind of the future state, it's the risk burden is substantially based in the post-production side, where performance monitoring, continuous performance monitoring, understanding the implication of model deprecation and performance shift and other key events just grows in terms of importance. And so I'd say kind of those would be the two angles to emphasize, would be that proportionality, that risk-based approach, as well as the recognition that traditional kind of risk management techniques continue to apply in a pre-production manner, and there's increased adaptation required, and this is where we spend a lot of our time on the post-production side of the world.
Thank you, Jeff. I see no other hands, so let's move on to the third question. What do we mean by responsible AI and by guardrails in the context of financial services? I'll start and others can chime in. Well, AI adoption can bring along significant benefits, but also risks, both to the institution implementing the AI as well as to the broader financial system. So responsible AI adoption, in our view, means having financial institutions be fully aware of the associated risks as they adopt AI, and taking proactive steps to manage these risks well in a way that is aligned with their governance, risk management, business objectives, as well as their regulatory obligations where these do apply. Well, guardrails in our mind refers to broadly the tools and the approaches captured under the 12 sound practices that help financial institutions manage risks associated with AI adoption. Happy to see if others would like to jump in. David?
I'll just chime in briefly to say, I think of a parallel to, say, using automobiles. So everybody's using automobiles these days to great benefit in a lot of different ways. But we all, try to use them responsibly by understanding how they work, by knowing the conditions under which we're driving, if it's rainy or foggy or snowy, and getting our automobiles regularly checked out to confirm that there aren't any problems with them. So I think, to me, responsible AI and then having guardrails, on our roads and so forth, is sort of a parallel.
That's a very nice example, David. Thank you. Question number 4. How do we performance with explainability, and are financial institutions required to produce technical risk evaluations for high-risk use cases? Maybe if I can invite Orlando or David to take this as well.
I might have a start, but I think this is something that David is quite keen on as well. So the balance between performance and explainability is use case specific, and I think that particularly with generative and agentic AI, explainability and even actually some machine learning models, explainability becomes more and more challenging to kind of attain in practice as well. So, however, in some cases, it may be paramount in terms of the prevention or mitigation or the redress of certain forms of harm as well. So the sound, so in terms of the technical risk evaluations, the sound practices and the examples provided in them are very a little more than reference points. They're not policy mandates at this stage. Obviously, in the realm of kind of traditional model risk as well, there are kind of established kind of explainability techniques, some of which might be applicable, some of which may need some sort of adaptations as well. But this is not an area where it serves us particularly well to be particularly prescriptive or granular as to what constitutes appropriate explainability, and also we also recognize the inherent technical limitations of some models of system when it comes to explainability. At which point you need to kind of consider kind of compensating controls, which may vary according to the use case and the harms that you're trying to prevent or redress, and those might range from enhanced human oversight, just to go back to an earlier question, to kind of longer kind of testing periods, more periodic kind of revalidations. It is ultimately going to vary as well. But explainability as an end in itself is a bit of a challenging kind of construct with some of the more advanced kind of capabilities that are being developed. I don't know if David has any more on this.
Yeah, thanks, Orlando. I obviously completely agree with all that, and in the broad spectrum of analytical tools, we have bumped up against explainability challenges in sort of traditional non-AI areas as well, for models that maybe have many variables, interaction terms, and so forth. But the issue is not brand new, but it is likely to be more common or exacerbated or amplified with AI. And so making those choices about what level of explainability, and I agree with the earlier point, explainability is definitely not a binary concept, and we tried to emphasize that in the report. What level of explainability is warranted? There may be specific regulatory or legal requirements, but there also may be a preference on the part of an institution to say in a higher risk area, just to have a better understanding, a higher confidence in the conceptual soundness of something. So we've seen some cases where institutions, even if they could, and Hernshin alluded to this, even if they could have a slightly better or higher level of performance, they go with one that is a little bit has lower performance, but they're more confident in understanding how it works. So there's really an interesting kind of spectrum there in terms of explainability, and then obviously factored by the materiality and level of risk. So I think it's actually a pretty fascinating area, and we've had a lot of good conversations with our institutions about what's the right sort of point on the curve, if you will, with explainability and performance.
Thank you. Would the lead discussants have anything to add? This is an area that most of you pointed out as well. Either?
Yeah, maybe. I don't know if you can hear me. I'm still having tech issues, but no, we absolutely agree. We clearly recognize that it is a spectrum, and there isn't a one size fits all, and that there is a balance between explainability, but then also security, accuracy, the customer impact, and as well as also being really able to appreciate what are the compensating controls you need and you have if you don't have that explainability. So we agree with the overall approach, but you're absolutely right. It's an area that requires a lot more discussion before we land on something that is implementable.
Thank you. So we'll move on to the next question. Did somebody want to jump in? No? Okay. So we'll move on to the next question, number 5. How do we think about local regulatory approaches, potential overlaps, and the role of authorities in adopting the FSB's work? I'll take this one. Well, the 12 sound practices are intended as a practical reference for financial institutions, particularly for their boards and senior management as they consider how AI governance and risk management practices should be stood up for the financial institutions that they lead. While they do not set any regulatory standards, authorities may refer to these 12 practices when developing guidance for their jurisdictions or in their day-to-day supervisory work. The sound practices of this report are broadly compatible with existing and ongoing work by national financial authorities as well as standard-setting bodies. So we would welcome, inputs from anybody if or you felt that there was any area of misalignment. We would caution and remind on one other thing as well, and that is that adopting the sound practices in this report does not absolve any institution from its obligation to meet local legal regulatory requirements related to AI adoption, because we understand these will evolve as we move along, and there might be some areas of differences. This is definitely not a legal document, and therefore financial institutions will still have to abide by their local rules. Are there other further comments on this question? Okay, seeing none, I shall move on to next question, number 6. What is expected on sector-wide scenario testing? I think this comes under section 3 of the paper as well. Maybe again, Orlando or David, would you like to answer this question? Orlando, please.
Yes, thank you. So this is I mean, one of the lead discussants earlier on, I do forget which one made a really good observation around the value of kind of public-private partnerships, and I think that when it comes to this, I mean, there are no kind of there's nothing more granular in terms of expectations than what you see in the paper, but I think this is an area where public-private collaboration can yield and has yielded really excellent results in the past, more in the realm of things like cybersecurity and resilience. And I think all that the sound practices really seek to do in that respect is to recognize that, first of all, some of the systemic issues that were alluded to before do require kind of collaboration across different parts of the financial services ecosystem, whether it's firms, third-party AI providers, etc., kind of working in unison, and that there are kind of established practices and methodologies in terms of scenario tests and exercises that some firms undertake, sometimes on a compulsory basis, sometimes on a voluntary basis, depending on the jurisdiction, which can really be helpful in terms of training the industry's collective muscle memory, as well as that of individual institutions, in terms of responding to potential future AI-related disruption. So I think it's just about building on those existing collaboration structures that exist in many jurisdictions and starting to consider about what AI disruption scenarios may look like, in addition to many of the other scenarios that are already kind of being considered, whether they be relating to cyber attacks or supply chain disruption. So it's just really kind of making that leap towards beginning to integrate, scenarios relating to AI in this established collaboration kind of frameworks and exercises that exist. Thank you.
Thank you. David, did you want to jump in?
Yeah, thanks. I obviously agree with everything Orlando said. The other point I will make is one doesn't necessarily have to think of sort of the more broad-based, formal, kind of enterprise-wide scenario tests or scenario analysis to find some benefit. Sort of lower level, what some people might call sensitivity testing in the use of AI can also be beneficial. Those can also be sort of lower cost, and as to my earlier point, help sort of map out the distribution of where certain AI approaches work well, where they don't work as well. And we've seen institutions, based on such sensitivity testing, set some guardrails for use within their institutions to say, you can use this here, you'll get good outcomes. If you use it beyond these parameters, you're likely to get less good outcomes.
Thank you, David. That's helpful. Are there other comments from lead discussants? Okay, if not, let's move on to the final pre-submitted question, and that is, have recent industry publications such as that from the FSSCC AI Executive Oversight Group been considered, and how can stakeholders contribute further insights? I can start, but I think, David, would you like to take this question?
Sure, thank you. Yeah, so one of the really nice things we had in putting together this report is there was a large corpus of information on which we could draw, and we were quite hungry in devouring all that and really benefited from it. So the report mentioned in the question, yes, absolutely have read that and benefited from that, and from other sorts of reports have been issued, either things that are on sort of AI use broadly or more specific publications, say on third party or on cyber. And so I think this is has been helpful, but also is indicative of the benefits of having a dialogue on this topic, this broad topic, as several of the panelists mentioned. And I think the fact that the landscape is changing just further fortifies the need for ongoing dialogue. My personal view is it's maybe less likely that there will be, a seminal report issued that lasts for 10 years. It's just the nature of how things are evolving. We'll need to keep up the dialogue and learning from one another. That said, with this report, we did try to identify some key sort of broad factors that could perhaps remain relevant even as as things evolve.
Thank you, David. We would now move on to the floor to see whether there are any questions. Can I ask Yasushi or Shaz if we have picked up any questions from the floor or via WebEx? Could you read this out for us, if so?
Yes, we have one question submitted via the message, so I'll read it out. What information would supervisors need directly from AI third-party providers, and how would supervisors access this information in sufficient depth or detail, and also globally consistently?
Yeah, I think this is, I'll start off. Really interesting question, and had some really good discussion today on the topic of third-party providers. It's something in the United States we've talked about quite a bit, and have issued guidance on it, both in terms of the role that our supervised banks should play in terms of sound risk management practices. But we also have things like our Bank Service Company Act, which provides a role or gives a role to supervisors to review the activities of certain third-party providers. So to me, it's a function of what each jurisdiction has in place in terms of the ability and authority they have to evaluate third-party providers, and what that specific role is. In the US, for example, it's more focused on the activities than on the organizations themselves. And so where the activities are relevant to a significant group of our supervised banks, then we have a role to play to evaluate those activities and confirm that they're being done the right way. I think it does highlight the need for this ongoing dialogue on the topic, and the emphasis on sort of public-private partnerships, or at least a dialogue on how does everyone get comfortable with using third-party products and services, but also have a full understanding or try to have a full understanding of the risks involved, and recognizing sort of where the burden should lie. I think there were some interesting comments today on that topic. I won't try to give a direct answer here, since it's a complicated topic and a lot of those decisions are above my pay grade. But I think my final point would just be, as we tried to emphasize in our report, and this is not just limited to AI, of course, where a supervised bank is limited in the information that it has from a third-party provider, it should make that clear. Obviously try to get as much information as possible, but if they've exhausted that, make sure that everyone internally is aware of those information limitations. And then the institution might, the supervised bank might consider some compensating controls, given that maybe they have some blind spots in terms of the risks. Welcome comments. I think Orlando maybe wanted to chime in.
Thank you. So I agree with a lot of that. So obviously in some jurisdictions, there are kind of frameworks in place or established that do give authorities a degree of direct recourse in respect of third-party providers or a subset thereof. In some cases, these are limited to just a layer of those that are deemed to kind of be systemic. But I would actually be inclined to reformulate the question a little bit in the sense that it's not just the information that authorities may need, but actually what information does the financial sector as a whole need? So what do financial institutions need in terms of assurance and information from third-party AI providers? And that may also kind of percolate through to authorities. And I guess we do have a fairly established and relatively recent regulatory architecture around third-party risk management that already kind of answers that question primarily from a resilience perspective. There's a lot of information about resilience that would that is expected from other providers, which very much would apply to third-party AI providers. The thing that's quite interesting, we try to touch upon in the report, is what additional sources of information and assurance, not strictly speaking relating to resilience, may financial institutions and authorities need from AI providers? Because that is where I see the more interesting delta. So there's information around, for example, their data governance process, their data quality, what how they source it, how they curate it, what lineage kind of processes it goes through, etc., which really does go to is really central to the subsequent performance of models or systems as well. So there's a lot of information that doesn't fall within the exact confines of resilience, as usually articulated in third-party risk management regulation, that is worth thinking about. How do you obtain that information is again an area where I think authorities, financial institutions, and providers can collaborate. I mean, you already have established transparency tools with questionnaires, you have model cards or system cards that do provide a baseline of this information as well, and these are emerging and maturing as well. But you could see a sort of world in which, whether it's through industry or some authority mediation, you could see a world where you have these transparency tools becoming more customized to the financial sector globally as well, and where you could get some assurance and information in those kind of models or system cards that addresses the risk management and regulatory needs of financial institutions. That is, like I said, is an area that is ripe for industry collaboration and potentially some triangulation with authorities as well, and where hopefully we can get a dialogue going off the back of this report.
Thank you, David and Orlando. That's very helpful. Do we have other questions, Shaz and Yasushi?
Yes, we have one question submitted. Third-party risk frameworks are often focused on operational resilience and continuity. Where a regulated financial institution remains formally accountable for an AI-enabled service, but lacks practical control or evidential access in relation to upstream technology providers, can these frameworks also deliver meaningful accountability, or do they mainly manage resilience risks?
I think I may have inadvertently answered that. Sorry.
Go ahead, Orlando.
Go ahead.
I think we may have inadvertently started answering this question with the previous one, which I think it's absolutely right. I mean, like the primary kind of focus of existing third-party risk management frameworks is as recently updated has been on resilience, and clearly that is fundamental. That is incredibly important. I mean, the developments that we've seen in the last few months around frontier AI models kind of bring this home. But I think the point that we were trying to make is that there may be information and assurance that doesn't squarely fall within the traditional kind of realm of resilience, which is more related to, like I said, the underlying data and training processes that models may have gone through, which is also going to become very important going forward, and is probably going to be integrated also into third-party risk management frameworks. But existing information and resilience is a good baseline and a good start, I would say.
Yeah, and I'll just add, what's interesting is this topic is not limited just to AI, obviously, but other areas where banks employ third-party products or services, and including newer technologies, it is definitely a significant challenge for banks. And that's why we continue to have these ongoing discussions about the ability to really map out the full set of risks that could apply, the level of information that's available to banks so they can manage the risks as best as they can, and then also their ability to monitor these third-party providers over time, and to consider what could be, in terms of contingencies, possible exit strategies if the banks sort of don't like what they see or performance degrades and so forth. So it's a very challenging area, and one that I think is ripe for ongoing dialogue.
Ada, did you want to jump in?
Yes, sorry. Yeah, I mean, obviously, I've talked quite extensively about this in my part, that I do think the existing frameworks for third parties work to an extent in this space, but we would also advocate that we should be thinking about when does the tipping point get reached, when we need to think about some of those critical providers in the AI space through the same lens or a similar lens to that we are looking at other FMIs. I think we are, given the pace at which this whole space is moving, I think we'll probably get there much sooner than we anticipate. So we would, I do think we need to think more broadly than just the traditional third-party risk.
So I agree with all that as well. And I would also note that the transparency on what your service providers are able to provide to you will change over time. And at the moment, there are lots of bits and bobs that may not be so apparent. And I think it's with this in mind that financial institutions, knowing that they remain accountable for the services to their customers, they remain accountable to regulatory obligations. And therefore, I think adoption has somewhat been careful in areas where there is huge customer impact. But in other areas, for example, such as fraud detection, the explainability might be a little bit less important, because you just want to be able to find as many ways to look for leads in fraud detection. So I think it also depends to a large extent on the implementation, the use case. But what I'm hearing overall, which is very helpful, is that the industry is saying there is a big potential problem here, not just at the level of the individual financial institution, but at the financial system-wide level. And it is something that we need to continue conversations in, work expeditiously towards. There's also a call for consistency, better consistency. I don't believe we will have perfect consistency. Even in the non-AI outsourcing areas, there is no consistency today, even across large blocks of jurisdictions. But I think general alignment in approaches, you would see that. And I think, internationally diverse financial institutions will continue to manage well their cross-border differences in terms of rules. But we hear you. This is a risk that is important for institutions, for financial stability. And I'm sure most regulators around the room, if not all, would be very keen to continue this conversation. David.
Yeah, sorry, I just wanted to offer one more quick suggestion that's straightforward. I won't necessarily call it easy, but is just to even have a gap analysis of the information that one would like to get from third-party providers and the information that they have. So what's the optimal information that they would like to have, and then what are you actually getting? And so just tracking that sort of difference or that gap can be helpful in managing the risks. What's interesting in the AI space is, even in some cases, even if a third-party provider hands over all the information that they have, there still may be some uncertainties about how the AI approach works. Some of the largest AI technology firms have admitted they don't necessarily know exactly how some of their models get from A to B. And so that's an interesting development in and of itself. So it's not necessarily that they might be withholding key information and not telling people, it's that there's just overall uncertainty at how it functions. So also differentiating between those things can be important.
Thank you, David. Yasushi, Shaz, are there more questions?
Yes, we've got some additional questions. Maybe we take them one by one. The next question is it's on agentic AI, which has been talked about already a lot. What impact will a move to agentic AI have on the governance and risk management approaches set out in the report?
Yes, let me take this one. So we have our sound practice number 4, which talks about adaptability. And that's exactly where we want to address such new technologies that come up. We say what we put out as sound practices, and also for the governance sections, it's not hit in stone. What's very important is that institutions are aware of what's happening externally, what's happening with technology, what's happening with risks that arise, and to adapt their frameworks accordingly. And especially with agentic AI, we see many additional risks that can come up. But the fundamental sound practices that we've described in this report apply here as well. Of course, it's higher risk, especially when we give it more control. And so more rigorous standards have to be put in place. But that's exactly the point why we do put a lot of emphasis on this adaptability. Nothing is set in stone. Continuously review what makes sense. Now we've seen these new risks, what needs to be adapted, what thresholds need to be adjusted, what new methods are out there that can help address the risks. This is what's important now for this agentic AI and any other future developments that might come up.
Thank you, Annika. Did you have anything to add, Anna? Please, you have the floor.
Thank you, Herjin. Can you hear me?
Loud and clear.
Thank you. Thank you. No, I think this is a very good point that Annika raises, and I just wanted to also highlight sound practice number 1 and the importance. We mentioned there the importance of having appropriate management information for senior management and the board so that they can provide appropriate direction and oversight. So as risks change and as the technology evolves and there are different risks emerging or points that need to be looked at with more detail, even the third-party dependencies at an institution, etc. I just want to highlight the importance to maintain that information flowing up to senior management and the board so that they are able to provide appropriate oversight and direction. Thank you.
Thank you, Anna. Back to you, Yasushi.
Thanks. Just pivoting back to the previous question, we've had a follow-up question on that topic, on third-party risk frameworks. To what extent is the shared responsibility model still valid for critical third parties and systemic risk?
David or Orlando, would you like to take this question?
I'm happy to have a go. I think this kind of transcends maybe discussions on the scope of the sound practices, but so the shared responsibility model was kind of conceived and developed initially as a way of kind of clarifying and demarcating the responsibilities of kind of providers of certain technology services and the recipients of those services in a kind of sort of evolving and dynamic kind of landscape, and it still has a degree of relevance vis-a-vis how individual institutions manage their relationships and risks as well. Although we have emphasized, and including in this kind of sound practices, that financial institutions remain accountable for the delivery of financial services to the economy. I think that when you are kind of bringing in a collective or a systemic dimension, like the notion of shared responsibility still becomes relevant. But you need to take more of an ecosystem-wide view in terms of how the actions of some organizations, might be financial institutions, might be providers, might be a combination of the two, can impact the whole financial services ecosystem. So it's not rendered irrelevant in any way, shape, or form. It's simply something that it needs to be considered in a little bit of a more holistic sort of sense in terms of how the actions of one individual node in the system can impact many as well. And that is kind of is something that we do consider very often in financial services regulation as well. But it's still kind of a pertinent and a relevant concept. It's just that you need to take an incremental or additional systemic lens to how you view things as well.
Thank you. I hope that answers the question, but if not, Shaz can remind us. We've just got 9 minutes left to the call, so if the Secretariat can prioritize the more important questions or for us, are there more?
So we just want to check whether there is anyone who would like to raise virtual hands. Please. We just check. Yeah, unfortunately, none. So, two hands raised.
Katrina Wilson.
So, first I will give the floor to Katrina Wilson, please.
Would you introduce yourself as you take the floor?
Hello? Hi, can you hear me?
We hear you loud and clear.
Okay, great. Katrina Wilson, I'm with the Investment Company Institute, ICI with Global Affairs. So I just wanted to make a few comments, let you know that we appreciate the opportunity to provide feedback on the sound practices. We're engaging with our members, and we do expect to provide a written consultation response. These are some just preliminary thoughts as we are still gathering feedback from our asset management members. We think the FSB has the overall right approach, particularly the balanced approach that has been discussed at length, recognizing potential benefits of AI, as well as the potential risks, and proposing a principles-based framework for governance and lifecycle management practices. We do strongly want to emphasize that existing regulatory and risk management frameworks should remain the starting point. Regulators should continue to take a phased approach, leveraging existing regulatory frameworks and risk management practices before considering additional requirements. And just a couple of thoughts as we're looking at the report and continuing to consider it. We appreciate the call for additional information or use cases from asset management, and we do hope to get some information in that regard from our members and be able to submit some more detailed information, particularly with respect to AI applications and investment research, and analysis of unstructured data, signal generation, trend analysis, as well as emerging uses in portfolio construction and trade execution. One additional point, we appreciate that the report references IOSCO's work on artificial intelligence, and we encourage a more prominent discussion of the 2025 IOSCO report on artificial intelligence in capital markets, use cases, risks, and challenges, which can provide more capital market specific insights, which could complement the sound practices and help readers understand how AI is being applied across financial markets. Thank you.
Thank you, Katrina. That's very helpful. We look forward to the use cases that you will submit in time. Yasushi, are there more questions?
So I just would like to once more just invite any virtual hands before closing. Okay, so it seems no more.
Are there further questions from WebEx?
No.
Okay, with that, let me just thank everybody very much for joining us in this lively discussion, providing your views, perspectives, and even questions. I think those help us think further, stretch our minds as to what else we may need to cover and address as we all hold hands and embark on this journey of AI adoption, of course, in a sound and responsible manner within the financial services industries. Thank you very much for joining us today. We look forward to your comments and contribution before by the deadline of the consultation period. Thank you very much. Anything to add, Yasushi, any admin before we close? Okay, if not, have a very good morning, afternoon, evening to everybody. Thank you.